Hello and welcome to another Trades and Tutorials video. This is Jeff Bish, president of MarketGauge.com, and in this video I am going to look at what areas of the market you want to be focused on based on the fact that the major indexes, SPYs, and the Qs are at a major inflection point right here. But before we start talking about individual stocks or stocks and ETFs, let me just make sure that if you're just finding us on YouTube, make sure you subscribe to our channel. And also, if you want to find more videos like this, you can go to marketgauge.com/tutorials if you're not already there. And also, if you want more updates, perhaps more frequently, make sure to follow me on Twitter at MarketGauge. And finally, you can get this video in HD by using the settings in the lower right-hand corner of the screen. All right, so what I mean when I say the markets that are a major inflection point is if we just look at the SPYs and just look at the Qs, in other words, S&P 500 and NASDAQ, on a weekly basis, we can see that the SPYs here, this green line is a 10-week moving average, so that's about the 50-day moving average. The magenta line is the 200-day moving average. And you can obviously see the price points. So markets tend to trade in levels, as you can see SPYs have done. SPYs traded between these two levels, roughly 205 to about 213 for the majority of the year. When they broke that level, they paused for a second here at the 198 level, and then I'm sure you're all well aware, it collapsed quickly down to 180 and have now come back up and had trouble back around this 200. But now we're above the 200 price point, I should say. We're above the 50-day moving average, and the next objective will be up to the 205. If we look at the Qs, the story is the same but stronger. All right, so its range for the year was really around where it is right now. It broke down. Remember, this is your 200-day moving average expressed in a weekly chart. And now it's actually moving back up above or struggling right below the 200-day. It's not exact because this is weekly, and above this breakdown level. So are we breaking out to new highs? No, absolutely not. Could it roll over? This would be a perfect place for it to roll over. In both cases, if they break down from unable to get through this resistance, it would be a perfect place to expect the market to roll over. I'm not going to cover that part right now because I think it's time to just make sure you are prepared with the right list of either ETFs or stocks if the market continues higher. So before the market gets to new highs, you want to be focused on what's leading the market. All right. Now, there's one other indicator that I look at that really has my attention right now for this exact reason, and that is the ratio between the number of stocks making new highs and the total number making new highs and new lows. So in a nutshell, and you can get this in our resources section in the little big view section. Let me show you. Resources, little big view, and when you do that, you'll wind up in this section, and then you go to market internals and look for the NYSE new high, new low chart. So in a bearish market, so we've had the most bearish market that we've seen in about 4 years. When that happens, this index, you want to see this indicator get down below 20 as it did nicely, and then you want to see it come back up over 30 as it's now done. Now, this is not an indicator that has the timing sensitivity of a day or a couple days. In other words, the fact that it's just going over 30 here is a big picture indication. Just like when it was above the 90 level and then fell below 70. That's a big picture bearish indication. And as you can see, this thing weighed on the market for a long time before it finally cracked. Okay, so what you want to do with this indicator is, one, it's a heads up that the market's experiencing more new highs. All right, now, what you don't see here is that we're only making about 60 new highs right now. I covered this in my weekly video as well. We'd really like to see the market making 100 new highs, so we do want to see the trend continue. But from here going forward, If this continues to trend higher, it's an indication of a market getting healthier. And when a market's getting healthier after a significant correction, that's where we are right now. And if that continues, where do you want to be? You want to be in the leaders. You don't want to wait until the market gets to new highs to look around and say, oh gee, I should be buying the stocks that are at new highs. No, there's already stocks making new highs. There are already ETFs that may not be at new highs yet, but they're leading the way higher. So let me show you how you can find them and give you a little bit of proof of the fact that this is actually a great way to look at the markets, especially after you've had a correction like this. Okay, and when I say like this, I mean it's not often that the market gets this washed out. And as you can see, it's not often the market looks like that either. So let's take advantage of it. And as always, in terms of protecting our selves, you just make sure that if the market does roll over, you get out of the way. All right, so again, in the same area of Little Big View, which I realize you might not have seen with this up before, so I'm just going to go to Market Resources and then Little Big View. It's all free at marketgauge.com. We have a couple of places that you can find leaders. So first of all, from a sector point of view, let's go to the sector summary right here. And I want to look for leaders over the last 6 months and even year to date. Okay, so if we do that, we see XLY. So XLY is one to want to go check out on the charts. Anything that starts to turn positive on this 6-month change, we're going to want to check out. All right, if for no other reason, if you haven't already seen this, at the bottom of this table, you'll see this chart. So this chart is aggregating the number of sectors in that table above that are positive over 6 months. So when we get back over the 200-day in the SPYs, we want to see at least 4 sectors positive. So we're definitely early. Okay, when we get to that point, then we've got a situation where the market has traditionally really started to run. Up to that point, I'm going to keep an eye, and this is what I'm suggesting you do, on which are the first sectors to move up into positive 6-month, and also keep an eye on what's positive year to date. Right now, as long as they're not defensive sectors, if the chart looks good, that's where I want to focus. So let's just take a look at XLY quickly. And I'll bring it to daily. I'm going to just get rid of this. We don't need the Fibonacci for this analysis. And now we're looking at the 50 and the 200. And so one of the areas I would focus on to determine whether or not the particular index or stock is in a good location is whether or not it's higher than the highs that it was making before it made its ultimate high this year. All right. Remember, we're not necessarily looking or waiting for it to make new highs on the year, especially as a ETF. But if it's above its consolidation after the collapse and it's above the consolidation before the run-up, if it had one like this one does, then this is one that is leading the market higher, and I'd look for opportunities on the long side in this particular area. All right, so the other one that was on that particular table just barely is XLP. Now, it just so happens that this one is also consumer related. So let's take a look at XLP. So XLP is still struggling with that area I referred to, the highs or the consolidation that it made before the ultimate high. So this one I would expect to struggle a little more. I'd focus more on XLY. All right, so that's one source, just simply looking at the leading sectors. Now, this particular table limits itself to 12 sectors, but behind the scenes here, we've got probably about 150 different ETFs that we scan, and when we scan them, in the market hotspots section, we'll tell you what's hot for the day, what's not hot for the day, but we also, and this is where I want to draw your attention to here, show you what's hot over 6 months. So same basic principle, right? Now, the short markets hot over the past 6 months, we know that. That's not what we're interested in right now. The euro, not part of what I'm looking for right now. Again, short EFC, not part of what I'm looking for. Vietnam, that would be an interesting to take a look at. It's only up 4%. We'll take a look at it. And KRE. Now, KRE didn't show up in the last chart because, or the last table, because it wasn't one of the ones that we look at as a basic sector. We look at XLF instead. So let's look at KRE and Vietnam. Now, Vietnam's obviously a foreign country ETF, so that's a whole different picture. But let's start with KRE and we'll take a look at Vietnam as well. All right, so KRE. KRE back up over the 200, back up over the 50, over the consolidation before the run-up. If I drew a trend line here, it's back through the trend line. So I've got an alert, and I'm already long a little bit, full disclosure, and I've got an alert to consider buying more if it gets back over what was the Fed day here, and you can also see that's basically the swing area from the original breakdown. So my point here is that, as you can see, XLY and KRE from an ETF standpoint are leading higher. All right, they're not at new highs yet, but if this market continues to move higher, I would expect these to be two of the leaders, and that's where you want to be. Now, just as an aside, let's take a look at Vietnam. I've already looked at it, and so I can shortcut the analysis by saying, yeah, it's been a leader. It's had a good 6-month change, but it's only up 4%, still in a really long bearish downtrend. So it's certainly not what I'd be looking for in a leader, although it is demonstrating an attempt to turn around its bearish trend. But for right now, that's not what we're looking for. What we're really looking for is leaders. And I told you I'd show you proof of how powerful looking at leaders can be. So now, if we look at stocks, which obviously are much more volatile, and in the case of stocks, you can look at stocks hitting new highs. The ETFs are just not likely to be hitting new highs right now, especially if you're looking at a sector. The markets in general is still down a little too much. But individual stocks, many of which are looking great. So I'm not going to go into the details of this system. This is more of a demonstration of how powerful it is to be in leaders. This particular system that we have looks at the strongest stocks in the NASDAQ 100. That's why we call them the All-Stars. And if you had only invested in the strongest stocks in the NASDAQ 100, going back to 2008, you'd be up with this systematic approach, 530%. That's the blue line right here. The Qs, just as a frame of reference, are only up about 150% in that time. And in this lousy year in the market where the Qs are up 3.4%, this particular approach has yielded over 14%. So what's the point? The point is that leaders tend to continue to lead, laggers tend to continue to lag. And to pull it all together, the best time to be looking for leaders is when the market has been washed out and looks like it's turning back up. I would say that's exactly where we are right now. It'll be easy to tell if the market rolls over at these easy to identify inflection points that I pointed out in the beginning of the video. And by the time we've broken out and have moved higher, I won't say it'll be too late completely, but you certainly will have missed the first train out of the station. So focus on leaders. That's a couple ways to do it, and I'll see you in the next video.